Welcome to Educational Alpha. I'm Bill Kelly, CEO of Kaya and your host, bringing you on-the-ground conversations with business leaders, educators, and industry colleagues from around the globe.
In this episode, Bill and guest Tony Davidow, author of Goals-Based Investing, a visionary framework for wealth management, discuss the evolving landscape of investing and the significance of adapting to it. Together, they examine relevant topics, including the impact of inflation on investment strategies, the trend of consolidation, the importance of diversification, and much more. Throughout their discussion, Tony emphasizes the value of education on alternative investments, access to world-class managers, and the incorporation of private credit and real estate in retirement portfolios. Listen in.
Tony Davidow, welcome to Educational Alpha.
Bill, thanks so much for having me.
It's great to see you. And I was thinking back, and you might not remember this. I think I first met you, maybe it was in Nashville, Las Vegas. It was what was then called IMCA.
Yeah.
You were either on the board or chairing the board, and Sean Walters was kind enough to invite me to an exclusive board-only dinner and some awards. And right away, I spotted you as somebody that really thought carefully about outcomes and the end investor. And it's great to be reunited 10 years later, although we do bump into each other periodically. So with that, maybe as a first data point for me, maybe a little bit of your background so the audience knows perspective when they hear you.
Sure. You don't have a camera, so you can't see how old I am, but clearly I've been doing this a long time. Bill, you and I are kind of contemporaries, and we've seen a lot of changes in the industry. I began my career working for a family office, spent about 15 years at Morgan Stanley, where I ran multiple businesses, including our ultra-high net worth consulting business, our institutional business, and then at the end of my tenure, running sales and training for the consulting services business. And then spent time at firms like Guggenheim and Schwab before most recently joining the Franklin Templeton Institute, where I serve as a senior alternatives investment strategist.
So you've seen a lot, as I have, and I think both of our careers span a little over 40 years, which is hard to believe. And a lot has changed, but maybe not so much to some degree. But I think a significant change that I saw, and I remember working for Bear Stearns in the 1980s, and they got us into a conference room and said, this nice defined benefit plan that all the partners once had, it's over. And Let me tell you about this thing called defined contribution. Here are a bunch of pedestrian options, and we're going to throw a little bit of matching contribution at you. Good luck. And off we went with maybe the new retirement paradigm, where it was really in our individual hands to save or to not save. And how we asset allocate was completely up to us. So I know you write a lot on this subject. I think you put out something very recently, but I know it's been something you're focused on, as am I and as is Kaya. So maybe your views on the state of the union of retirement, and do we have a crisis, semi-crisis? Are you optimistic, pessimistic?
Yeah, it's interesting. I think as an industry, we need to evolve. And I think in retirement in particular, it's an area where I think we really need to rethink some of the things that we were told early in our careers. Bill, you probably remember when I started in this business, they used to talk to us about, well, your fixed income allocation should equal your age. So in other words, as you get older, you get more conservative over time. Well, that worked fine when you retired at 65 and died at 70. But the reality is people live longer, more productive lives. And I think one of the things that kind of hit us between the eyeballs last year was the 60-40 portfolio being down double digits, with both the 60 and the 40 being down. I think a lot of advisors and a lot of investors had to rethink their retirement strategy to say, do I in fact need to have a rethinking of that strategy? And do I in fact need to expand the number of tools that I use to achieve my outcomes over the long run? And I'll break it down into two pieces. During the accumulation phase, I would argue we need alternatives because we need more growth in our portfolio. But I think we've had this misperception that as we got older, we needed to be more conservative. But now with people living to be 80, 90, 100 years old, we now need to think about how do we live longer, more productive lives in retirement. And I think for me, what that means is we need to extend the runway, and we need to think about using different sort of tools. And I think of things like private credit and private real estate as really effective tools of providing both growth and income in our portfolio. So as much as we used to think that when we were getting close to retirement or in retirement, we were conservative and we might be all fixed income, I'd argue we also need growth, we need income, and we need to think about what's my retirement plan for 20 to 30 years in retirement, not just getting there. So I think you're exactly right. We definitely need to rethink our retirement strategy. And I think last year just served to kind of punctuate the need to evolve our approach.
And maybe just starting with the 60-40 and what happened last year in 2022. I think two things, to oversimplify it. One is the sovereigns around the world turned off the liquidity hose, which has been just firing liquidity into the marketplace. And this 35, 40-year bull run in bonds finally ended because rates were pinned to zero. But then at the beginning of 2022 through the end of the third quarter, they went up 350, 400 basis points. And that's obviously the death knell for fixed income land. So yes, they did correlate, but for reasons that were maybe not market driven. And as you get into the first quarter of this year, 2023, I think if I remember correctly, first quarter, the 60-40 was up maybe 5-6%. So I don't know if the death of it in the obituary is written too soon, but maybe your thoughts on that. And then I want to follow on about how we really should be defining diversification, but maybe your thoughts on whether or not this was just an aberration.
Yeah, and I think we need to be careful. So when I say the 60-40 portfolio needs to evolve, what I'm really saying is just merely allocating to stocks and bonds. I think some advisors have kind of interpreted the 60-40 to expand the toolbox, and they're not just thinking U.S., they're thinking international, and maybe they're including some alternatives along the way. So Harry Markowitz recently passed away, and I know you and I both penned notes to the effect of what an influence he had on the industry. I'm not suggesting diversification doesn't work. I'm just suggesting you need a broader set of tools when you think about diversification. So to me, I think the limitations of 2022 were largely that what we saw is stocks and bonds were highly correlated, right? Stocks and bonds were both down double digits. So that is a phenomena that I think we need to think about, that whenever we get shocks to the system, and it wasn't only in 2022, whenever we've had these short-term shocks, we've seen all major traditional asset classes kind of move in lockstep with one another, and correlations tend to rise. So clearly there's a need for tools that provide better diversification. You and I were talking before the call that the expectation are equity returns are likely going to be lower in the future. Therefore, we need to think about what sort of tools can we use to provide additional growth, incremental growth in our portfolio. We talk about fixed income where it had been challenging. How do we get alternative sources of income in our portfolio? And lastly, I think one of the new phenomena we need to think about, which you and I remember, and I think some of the younger folks were caught off guard last year, and that is how do we solve for the corrosive impact of inflation? And again, all of those tools and all of the things that we're trying to solve for, I think can be used. Alternatives can help solve for some of those issues over time. So I think that's the way that I think of alternatives. I don't think of them as a monolithic investment decision. I think of them as discrete investment decisions where we can actually solve for the things that we need in our portfolios.
Well, at the very beginning, you said something that I liked a lot. You said beyond stocks and bonds. And you could have said instead of stocks and bonds. And I think this is part of some of the dangerous narratives, which is the 60-40 is dead to me. It should be dead to you as well. And you need this third bucket called alternatives. And I just don't think that's absolutely the wrong approach, because I think you're scaring the end investors as opposed to can you diversify within that 60? And even inside of private equity, should you be thinking beyond just the buyout space? And should you be thinking about, and I think you wrote something on this recently too, the secondaries, which has become a much more active market. And if I think back to the GFC, that was kind of a distressed market. The bid-ask spreads were very, very wide. You didn't go there for normal reasons. You went there because you needed liquidity and somebody would provide it maybe at a price you didn't like. But with this denominator effect, there seems to be a lot of opportunity there. So maybe talk about private equity not being an asset class, but being a pretty complex industry, and maybe some of the entry points you like within that broader definition of private equity.
Yeah, Bill, I think you're speaking our language. It's so important that we have those broader discussions. It's private markets broadly, private equity, private credit and private real estate. But then you get into private equity and you just think of the diversity of the ecosystem, right? Buyouts and venture capital, different ends of the development spectrum. And then you mentioned this new phenomena. And I know people in the secondary space will say they've been doing this for a long time, but up until the last couple of years, it was a pretty small niche sort of industry. But I think because of the denominator effect that you mentioned, and because more people are looking for diversification across their private equity exposure, you're starting to see this really burgeoning secondary market, which we think is a really attractive place to be now. And in fact, if we look at private markets broadly, we would say, secondaries certainly look very attractive. I think you could draw some parallels to the GFC when you look at the opportunities in private credit. Again, think about it. After the GFC, the banks stepped away from being the traditional sort of lender, and you saw private credit managers kind of step in to fill that void. I think that sort of opportunity exists in the marketplace today. And as much as I think real estate maybe gets a little bit of a black eye, to your point earlier about the diversification across, offices, I think, have been struggling, and they were struggling before COVID as people aren't going to the office and using them in the same way. But clearly there are opportunities in sectors like industrials and multifamily housing. So I think when we talk about all of these, we need to talk more broadly. It's interesting, you and I kind of grew up in the beginning of the industry where we're talking so much about you can't think of all equity being the same, value is different, growth, large is different than small, and US is different than international. And then for whatever reason, we make this generalized sort of view that all alternatives are created equally or all private equity are providing the same risk and return characteristics. So we need to have that more granular discussion to understand how to use these tools more effectively.
And as I think about accessing some of these tools and asset classes, for want of a better term, I think back to the origins of the 401k plan, and all of my options were in the 40 Act liquid space, not even liquid alts. I may have had a money market fund and maybe various equity and fixed income funds. And if I've got a managing my own IRA, I can maybe get into some other products. But any employer-based plan, you typically just can have garden variety offerings. As we start to see this opening up, my fear is that we're going to play into the tendencies of what the investor wants, which is next day liquidity. And if you're taking some of these more complex asset classes, but I even would argue the S&P 500 is meant to be held for the long term, not traded intraday. But do we run the risk of giving the investor what they want, which is liquidity on demand, versus what they should really be demanding, which is long-term investments to manage a long-term retirement plan?
Yeah, I think it's such an important issue, and it's something we emphasize in all the things that I write, and I actually pen to paper on the cost of being too liquid. You're exactly right. I think advisors and investors often think they want to be 100% liquid. If you took private equity, private credit, private real estate, and put them in a 100% liquid wrapper, I would run the other way, right? Because the reason you invest in those is because over the long run, you get this illiquidity premium. And the long run is 7 to 10 years. That's really the mindset we should have. Even though some of the newer structures, interval and tender offer funds, have quarterly, what I call liquidity valves, if you needed to get access to your fund, there's certain redemption available to you. I think we should think of them as long-term investments if we want to recoup that long-term illiquidity premium, and we shouldn't think of them as short-term strategies, or the structure shouldn't be thought of as trading vehicles. So I think maybe this kind of ties into the broader theme of your whole podcast series, which is, I think as we get ready to introduce these strategies to more 401k and maybe they become more prevalent in target date funds, we need to couple that with education. And the education not only needs to focus on the merits of the underlying asset class, but some of the structural trade-offs and why it's important to think of these as long-term investments.
And this has come up several times in the course of this program, where you've got to be looking at the liability side of the balance sheet. And you've got to have open and honest conversations with the investor to say, if you're 25 and you don't plan on stopping your work life until 65 or 70, why is liquidity a page one risk for you? And I think if we put it from that vantage point, I think the light goes off, as opposed to, well, No, I can't afford to have 30% illiquid. Well, maybe you can. Maybe you can afford to have 50% illiquid. And this is how Swenson went about it at Yale, that
Yep.
he looked at the call in his capital, and it says 5% a year. So I can be very illiquid and capture this illiquidity premium, travel in the markets where capital formation is happening, and off to the races. It's a little bit more complicated than that, but I think we always have a tendency to start with an asset allocation play as opposed to, let's start with the right side of the balance sheet and talk about what your liabilities are.
Yeah, in this paper that I mentioned, the cost of being too liquid, one of the things I wanted to do was, and I look at Swenson and the work that he did with Yale, and I try to personalize that for an advisor to say, maybe part of the discovery process with clients should focus on how much of your portfolio are you comfortable being illiquid. Maybe it's not 70 to 80%, maybe it's 10 to 20, but I would imagine there's a portion of it that you could be comfortable being a long-term investor. You carve that out, you call that your illiquidity bucket, and you truly treat that as a long-term investment. You don't tinker with it, you don't think about rebalancing around it. I also think it instills this discipline in investors because aren't we always trying to teach investors to be long-term oriented? Every time you sit down with a client, I think about all the years that I've been meeting with clients. I've never heard a client say, every client's a long-term investor until you get a market correction. And then if I can make it to the end of the quarter, that's a long time. So instilling that discipline in a portion of a client's portfolio, I think is a very positive thing.
I absolutely agree. So you mentioned inflation before, and I want to come back to that, but maybe start with two observations. And I didn't get a chance to read this fully, but PwC just came out with their Global Asset and Wealth Survey. And a couple of observations there. It seems like the big are going to get bigger, and 1 in 6 managers will either be acquired or just wiped off the face of the earth. And I think that in some degree plays into a research paper that Kai is now working on around TPA, total portfolio approach. And I think that this is a building upon what Markowitz did with SAA. So diversification is not going away, but talking about one benchmark as opposed to how did my equity piece do? How did private equity do? How did private debt do? And I think if I'm going to deploy TPA, if I'm deploying that on my own as a retiree, I really need to have a manager that's got a lot of solutions on their shelf. Because if I'm going to one manager for one thing and the next for then all of a sudden these managers are competing for share of wallet, and I'm going to lose at the end of the day as an investor. So I think that this 1 in 6, I don't know if that's right or not. I think you're part of a very large and growing platform as well. So you don't need to comment on your shop specifically, but maybe your views on how does this play into a total portfolio approach? And is it a better mousetrap than SAA, or maybe just building upon what SAA was able to create in the first place?
Yeah, it's interesting. And again, I'll take off my Franklin Templeton hat and I'll just think what has been happening over the industry. You've seen a lot of pressure from index products, which have been a real threat to the mutual fund industry overall. A lot of those firms have felt a lot of fee compression, which means you need to rationalize your products. Maybe you shrink the suite of products that you have available. But I think the other phenomena that we're starting to see now is the consolidation. So as the margins are coming down, you're assuming that there's more scale in the industry. I think that's a healthy sort of evolution. I think that happens in all industries. It's just now happening to the asset management industry. I suspect it will continue to consolidate. I don't know if the number 1 in 6 is right, but I do think that will likely continue over time. I think in the discussion we're having beforehand, maybe the one area that you won't see the consolidation, though, is in the alternative space, where I think there still is a premium for those boutique managers who can deliver alpha over the long run, and you probably don't want to tinker with those firms too much. So I would imagine over the next couple of years, we'll continue to see some of the trends that we've been experiencing over the last couple of years. As it relates to your comment about total portfolio approach, I go back to my old Morgan days dealing with a lot of our very wealthy, ultra high net worth families. And we were talking about that because we understood that some of the benchmarks that we use as an industry really don't make a lot of sense. I don't know if beating the S&P is an appropriate benchmark or not. It probably isn't in most situations. What we're really focused on is, as a whole, are we providing a higher likelihood of achieving a client's goal over the long run? So however we bring all those components together. I think we need to be much more focused on solving for goals and solving for things that are realistic and attainable for clients, as opposed to falling into the trap of trying to outperform the market when it's rising, which probably causes us to take on too much risk. Or when you have corrections, the client's typical reaction is, well, I would have been better off sitting in cash, which is not a strategy. That's a reaction.
Well, I think you've given me the perfect segue to inflation, Tony. So if I'm solving for goals, I don't know where inflation's sustaining. It ain't 2%. I think the UK is printing a number close to 10. I don't think it's that bad in the United States, but let's round it up to 3 or 4. And in the same PwC report, again, I haven't looked at it. I'm assuming it's nominal, that they're talking about global AUM growth of 5%. So you net 3 or 4% of inflation against that, you're barely running in place. So if I'm responsible for my retirement, I think the first building block has got to be inflation. And then what do I need on top of that? And maybe expectations need to be tamped down a little bit, because if inflation is 4 or 5%, and you're expecting 8 net, that is a very, very hard bogey to beat. So what are realistic expectations? You don't have to quantify it specifically, but maybe to ask it another way, are investor expectations aligned with reality in the current environment we're in?
I think for so long, advisors and investors didn't have to think about inflation because it was below 2. And remember, the Fed was trying to get up to 2. It wasn't part of the equation. I don't know where it ultimately reaches kind of equilibrium, but I would argue that it's something we do need to factor in. And certainly when I think about what we're ultimately delivering to the client needs to be after inflation, after fees. So it's a higher bogey than certainly where we were in the middle of the bull market. So in the middle of the bull market, 2009 to 2020, the S&P is up 13%. That was kind of the easy button. The 60-40 portfolio worked just fine. I got all the return, and I got higher return out of my S&P allocation than I have over the long run. I don't know what the returns are going to be, but I look at things like capital market assumptions, whether they come from Franklin Templeton or Morgan or Goldman or BlackRock. I think everyone is showing lower expected returns in the future than what we've experienced. So if I'm getting lower expected returns, inflation's higher, and fees are an issue, all of a sudden I need to find, where am I getting my incremental returns? What sort of investments can help me hedge the impact of inflation? So it's definitely part of the dialogue and part of the analysis we should be doing with our clients.
I agree. And it's maybe just a couple of the quickies as we move toward conclusion. Kaya's got our core curriculum, which you know quite well, and we're always thinking about where to bring it next. And there's only so much real estate we can fit in there, real estate being topics. And we not only have to get the topics right, we have to get the weightings right as well. And the topic of geopolitics has been on the fore. A lot of people talking about that. A lot of smart allocators we're talking to are encouraging us to give that a hard look. How do you think about that, maybe to high net worth down to the mass affluent? Is that too much of a complex factor for them to be thinking about? Or maybe it's up to their advisor to be thinking about it, but is that a real factor that we should be paying attention to as investors?
Yeah, I think it's difficult to model geopolitical risk. We know that they're out there. It's probably the ones that we're not thinking about that catch us off guard. I think the way that I think about it, though, is I know that there's risk out there, and I know that risk creates volatility in the market. And I want to make sure that I am modeling for risk. I know that we're going to have shocks to the system. I don't know how severe. I don't know what's going to cause them. I don't know when they're going to come. But I think it's safe to assume that we will have more shocks to the system over time. So I need to build that in advance. So when there is a geopolitical risk or something unforeseen in the marketplace, client portfolios are prepared for it. So that's the way that I tend to think about it. And, we certainly live in a volatile world where, there could be something tomorrow that we've never thought about. So there could be tangential sort of things, could impact a particular sector of the market. Then we could be a little bit more responsive to that.
And I think this brings us all the way back to the beginning part of this discussion, diversification, where if there's going to be a shock to a system, hopefully you're not overweighted in one or two asset classes where you're really going to have it hit. But we've seen the bite of these bear markets, including the GFC, peak to trough, the S&P drew down 50, 55%. but it doesn't stay in the cellar for very long. And then the recovery side of it lasts, in this case, for a couple of decades almost, it seems like. So you really have a lot of runway in front of you if you're in your early 20s. And I think probably the most important thing to get right is a long-term game plan that you stick to. And these periods of volatility are going to happen. I think we probably have some ahead of us this year. We haven't had a chance to get into demographics, but I think the Fed thinking they can control unemployment, I think it's almost delusional. It seems like every restaurant I go into, and I'm down in the Cape now, every establishment is short-staffed, every single one of them. So I think that we are in an employee market to some degree. So demographics, I think, are an issue as well. But we're not going to solve for all of that. But Tony, I love the research you do. You've been a great partner of ours. I know you've worked with Aaron on the Unified platform quite a bit. I appreciate all you're doing. Maybe in the way of just a closing observation, you could take this in whatever direction you want. But what are you working on right now? Is there another book in you, a piece of interesting research? What's top of mind as we sit here today?
Yeah, maybe I'll just kind of frame as we see the environment now, and then I'll kind of take that a step further. But look, I think you and I have been doing this for a long time. I think the market environment is demanding a different playbook, right? It's demanding a broader set of tools than we've had historically. You mentioned products. I think product innovation is making those investments more accessible to individual investors and through the advisor channel than ever before. That's a good thing. And at the end of the day, it only works if you have access to world-class managers, right? You don't want a watered-down version, or you don't want somebody who's never trafficked in the private markets before all of a sudden say, I too can run a private market fund. So I think there's a confluence of events that really makes this a tremendous time for alternative investments, probably the best opportunity that advisors have ever had. They've had more product at their disposal, really good products at their disposal as well. But I think, to tie it into your theme, there is a need for education, right? Advisors, at the end of the day, the advisor needs to lead with education. They need to know the products. They need to know the merits of the underlying strategies. They need to help clients have better informed decisions. So most of the work that I'm doing is really around that. How do we help advisors have better discussions with clients? How do we help them think about the impact of adding alts to their diversified portfolios? I never mention any products. The fact that I work for Franklin Templeton is kind of secondary. My job is really to help the advisor think through how to make better informed decisions about allocating to alternative investments.
Well, I'm going to lead with education. Very hard to top that. So Tony, great discussion as always. Keep up the great work. Franklin Templeton has been a great supporter of the work that we do through this Alts series. Jenny Johnson actually spoke at Alts New York, and you folks have been tremendous supporters of our mission. It means a lot to us. It means a lot to the global investor out there. So thank you.
And thank you, Bill, for all the work that you and your organization have done. You've really changed the way that people think about alternatives, and it has been a real pleasure to work with you and your team in the past, and look forward to doing the same in the future.
Same from my side. Nice to know that a couple of old guys still have some tread left on the tire. Thanks, Tony.
Thanks so much.
Thank you for listening to Educational Alpha. I'm your host, Bill Kelly. Learn more about the CAIA Association and subscribe to the show at caia.org. That's CAIA.org. See you next time.